Guys, this is S&P 500 Technical Analysis for the week of January 3rd, 2023. That is from January 3rd, Tuesday to January 6th, Friday. Now, the most surprising thing that has happened here in the entire stock market is the closing of the indices. So, if you look into the S&P 500 and also to the Dow Jones, then you will notice that there is a bullish hammer. And this is all what has happened in last 30 to 35 minutes. And if you notice that in my second update on December 30th, 2022, I've told my YouTube community members that the last 1 hour or 30 minutes can give some moves because people will try to close their trades because of the long weekend, end of 2022, Friday expiry, year end expiry, etc. And this activity can bring some movement to the market, means the stock market, means the indices. Can't be said to which direction that movement will come in last 30 minutes or so, but for now, considering the current movement of the market, it's expected to remain in or below the zone of 3840, right? So I told my YouTube community members that there will be a movement. Number one, there will be a movement in last 30 minutes or 1 hour for sure. Okay, there will be. Other than that, we do not know that to which side, okay, this the movement will come. Okay, but what we know is that irrespective of any movement in the upside, the movement will be confined to 3840 in or below the zone of 3840. And if you notice the exact closing is 3840, right? This is what I have mentioned here in my second update to my YouTube community members. But the most interesting part is that the S&P 500, it was able to survive, right? Last week also, okay, one more thing that I have mentioned here, that if the S&P 500 closes below the border, and what was the border? The border was 3805. If the S&P 500 closes below 3805 and 3790, in that case, we will wait for one more closing because we need to see, we need to confirm, okay, this, that whether it is going bearish or not through two consecutive closings. If you have subscribed to my channel for last many months, then you know that I always emphasize on this, the two consecutive closing. This is the concept of two consecutive closings in order to confirm the bullish or the bearish. And this is exactly what I mentioned in my first update on December 29 to my YouTube community members, that I hope you understand the true meaning of two consecutive closings before confirming the actual trend or breakout. Now guys, we are going to discuss the agenda of this S&P 500 technical analysis. In this agenda, the first point is the S&P 500 technical analysis on the weekly chart. So I will tell you that what is happening on the weekly chart, whether it is bearish or bullish, or what we can expect from the S&P 500 and the Dow Jones and the Nasdaq in the coming week based on their weekly closings, right? So weekly chart means the hawk eye view, means the big picture, the trend itself. Then the point number two, I will talk about the recession for the year 2000, sorry, not for, but from the year 2023 to 2025. So this will be a long recession. Okay, again, another, great recession or the great recession. So I will tell you that how the recession is going to begin, when the recession is going to begin. Okay, most expected. What will be the levels that we can expect from the S&P 500, okay, to hit in this the year 2023 2024, okay, like 2500, 2300, 2200. Okay, these are the levels that I will talk about technically. Again guys, everything is technical, right? Then guys, in the point number three of our agenda of S&P 500 technical analysis, this is the point number three is S&P 500 support and resistance levels. So I will give you the support and resistance level, just like I gave you the border 3805, 3840, the zone 3760, 3735, etc. Okay, these are the levels. So I will give you these the support and resistance levels for this the zone, and also this the zone, right? Then guys, in the point in the fourth point of our agenda, okay, it is the S&P 500 technical analysis on the daily chart. See, this was the first one, was the S&P 500 technical analysis on the weekly chart, means the hawk eye view, the big picture, the trend itself. And this is the point number four, S&P 500 technical analysis on the daily chart. So I will tell you that what is happening on this the daily chart. So when we see, okay, these 2, 3 or 4, 5 candles, then what is the meaning of okay, of these the candles, how these candles are going to impact the immediate movement of the S&P 500, where will be the open on Tuesday, and what will happen after open, okay, up or down. Then guys, in the last point, that is the fifth point of our S&P 500 technical analysis, I will tell you the probable movement of S&P 500 from January 3rd to January 6th. So based on the technical analysis from the point number 4, okay, I will deduce the probable movement of the S&P 500. I will tell you that what is going to happen in the S&P 500, whether it will move up, whether it will come down, how it is expected to behave on Tuesday, then Wednesday, then Thursday, and then Friday. Okay, just like, okay, we have seen here, this is the movement, okay, up, down, up, down. But guys, once again, this is the weekly technical analysis, and whatever I'm telling you, okay, it is for the entire week. And in this the entire week some course correction, okay, might be needed. That is why I have this the YouTube community where I give the daily updates, the daily analysis to my YouTube community members, okay, and I tell them that what they can expect, okay, in that in like 4 hours, okay, or in that the entire day. Okay, so this is where, okay, I give them this the course correction, and I tell them, okay, that what is going to happen, what is expected for today, where will be the open, okay, and what kind of open, what kind of movement we can see. So that is for this the course correction, and to be a little more precise. Okay, so that is the daily analysis, the daily updates and the daily analysis of the S&P 500, but only to my YouTube community members, right? Anyways, so guys, there is this one more thing, okay, that I want to clear, that this technical analysis is not a financial advice of any kind, in any form, or in any manner. This technical analysis is not an advice to place your trades in the stock market. So whether you make 100% profits within a day, or you see 20% losses within a day, these profit and losses are all yours and as per your understanding of my S&P 500 technical analysis. And guys, there is one more thing, that this S&P 500 technical analysis, it might get a little lengthy. That is why I've created the sections in this, the S&P 500 technical analysis. Whichever section you want to watch, you can watch. Whichever section you want to skip, or if you want to rewatch, you can. So guys, we are going to begin with this, the first point of the agenda, and this is S&P 500 technical analysis on the weekly chart. Let's see how the S&P 500 is doing, and also the Dow Jones is doing on this the weekly chart. Okay guys, so this is the weekly chart of the S&P 500, right? So guys, once again, if you have not subscribed to my channel, then please subscribe the channel and click on the bell notification icon so that you can get the weekly technical analysis and other informative videos that I share time to time. And other than that, if you want to join my YouTube community in order to get the daily analysis, the daily updates of the S&P 500, then you can click on this, the join button that is there, and you'll be able to join my YouTube community. So guys, so this is the weekly chart of S&P 500. Weekly chart means one candle represents 1 week, right? One candle means 1 week, not 1 hour or 1 day. Now, so this the technical. Okay, so yep. So first comes the candle itself. Okay, so if you notice the candle, it's a small bearish candle, and it looks like a doji candle. However, it's not a perfect doji. Okay, it looks like a doji candle, but it's not a perfect doji, and it's a bearish candle. The open of this the candle was 3843, and the closing of the candle was 38 almost 40. Okay, but the closing of the candle is in the upper half of the candle, means above the 50% mark of the candle itself. This is indicating that even though the color of the candle is red, there were still some bullish movements in the S&P 500 at the time of closing on last Friday. So as of now, this is the only interpretation of the candle. Now guys, let's look into these the technical. So guys, first comes the Bollinger Bands. If you notice, this is the lower band of the Bollinger Band, this is the median of the Bollinger Band. Because the S&P 500 has closed in between the lower band and the median of the Bollinger Band, this means that the S&P 500 is bearish through the Bollinger Bands. Guys, then comes the Ichimoku. If you notice that the S&P 500 has closed below the Ichimoku cloud, this means that the S&P 500 is bearish through Ichimoku, right? Then comes the moving averages. No crossover in the moving averages, and this is the third closing below all of the moving averages. This indicates that the S&P 500 is bearish through the moving averages, right? Now let's see what other technical indicators are saying. So we have the MACD. MACD looks like that it is about to cross over just two more candles, two more bearish candles, or just one heavy bearish candle, and then there will be a crossover in the MACD. But for now, MACD is less than the signal. This means that the MACD is directionally bullish. However, both MACD and the signal both are negative. This indicates that the S&P 500 is still trading in the long-term bear trend, right? Then comes the stochastic RSI. K channel is less than the D channel, and this indicates that the S&P 500 is bearish through the stochastic RSI, right? Then the divergence is normal, volatility is okay, not a problem, okay, and all other technicals are saying it's okay, it's all right. So now what we have noticed is that the S&P 500 is bearish through the Bollinger Bands. S&P 500 is bearish through the Ichimoku. S&P 500 is bearish through the moving averages. S&P 500 is bearish through the stochastic RSI. S&P 500 is directionally bullish through the MACD. MACD is what? Moving average convergence divergence, right? So that is the only factor. However, MACD is also trading in the long-term bear trend. This means that once again, S&P 500 is 90% bearish and 10% bullish. That's it. Okay, means the S&P 500 is trading in the long-term bear trend. That's it. Okay, long-term bear trend. So these the upward movements that you are seeing here. Okay, these are all corrections. Okay, these are short-term corrections, nothing else, right? So guys, what we have noticed is that on this the weekly chart of the S&P 500, S&P 500 is bearish. It is not absolute bearish, but it is bearish or heavily bearish, right? When I say bearish, that does not mean that every week you will see red candles back to back. No. Okay. It might or might not be, right? But the bearish means that no matter what happens, the entire stock market, the S&P 500, okay, it will come down sooner or later. It will come down, and that the direction, that the movement of the entire stock market, it will be bearish. As simple as that. So you might see, okay, one green candle, then red candles, then one green candle, two green candle, then red, etc. This will be the natural movement of the stock market. Now, guys, let's move on to our second point of our agenda, and that is the recession in the year 2020. From the year 2023 to 2025. Okay, so let's see technically how that is happening. Okay, what will be the implication? Okay, guys, so we are here and we are going to discuss the second point of our agenda of this the S&P 500 technical analysis, and this the second point of our agenda is the recession from 2023 to 2025, right? So this will be again the Great Recession. Okay, but see, it can even like 2026. Okay, so this will be a Great Recession or Great Recession this time. Okay, so we are going to talk about the factors, the technical movement, okay, when we will call it as a Great Recession, okay. And some are saying that the recession might not happen at all, right? So we are going to discuss these points here. So guys, once again, if you have not subscribed to my channel, then please subscribe the channel and click on the bell notification icon. And other than that, if you want to join my YouTube community, in order to get these the daily updates, the daily analysis of the S&P 500, then you can click on the join button that is there just below the title of this video, and you'll be able to join my YouTube community, and you will get the daily analysis and the daily updates of the S&P 500, right? So guys, now let's discuss the recession. So first of all, guys, we need to understand that why we are talking about the recession, why the recession is happening, and why everyone is talking about the recession. Okay, so the reason is that before the pandemic, okay, COVID-19, before COVID-19, there was this natural movement, okay, normal movement, okay. So we have seen this the normal movement in the S&P 500, in the entire stock market, in all of the indices like Dow Jones, okay, and Nasdaq, and the European markets, and the Asian markets, everywhere, okay, everything was normal, okay. During pandemic, there was almost so during pandemic, what has happened that all of the stock markets, the worldwide stock markets, okay, they have gone down heavily in a very short period of time, February and March, heavily. Okay, these are stock markets. So that was because of these the measures, okay, these the preventive measures, okay, from this the COVID-19 and whatever has happened at that time. Okay, thereafter we have seen a very strong rally. Now, why we have seen a very strong rally, even though there was this the pandemic was still there, but we have seen a very strong rally. Okay, for this the very strong rally, there were two reasons or more than two reasons. The very first reason was the stimulus. Okay, so the government has provided this the stimulus package to all. Okay, to means not to all, but like to almost everyone, to make sure that people, okay, they should get the money, okay, to buy the essentials, right? Now other so this has happened in many of the countries, okay, in the European, in not all the European countries, some of the European countries, okay, in the North America, okay, in US, in Australia, okay, this has happened. So governments have provided this the stimulus money, okay. But what we know is that the US stock market is the biggest stock market of the world, okay. It is like $27 trillion or $30 trillion, okay, this stock market, right? So whatever happens in the US, whatever happens in the US stock market, it impacts the global stock markets, the worldwide economy, right? Oh, so the reason was, first one was the stimulus package. Government has given this the stimulus package to okay, to the people. Now, people, they were clever. They were very much clever. Okay, so they have used some money, and they have used most of the money. Okay, and they have used most of the money to trade in the stock market. Okay, so this is what they did. So what has happened is that whatever the stimulus package government has provided to the people, they have put that money in the stock market. Stock market got the fuel. Okay, what is the fuel for the stock market? The money. Okay, and that money came from here, from the stimulus. Okay, because the money was flowing in the stock market. Okay, and people were buying. It was just moving up, right? This was the very first reason that the stock market got the fuel that it needed, right? Number two, so the second reason was the rate cuts, okay, that the Federal Reserve has slashed down the rates, the interest rates. Okay, why the Federal Reserve has slashed down the rates? To increase the demand in the economy. Okay, so what happens when the Federal Reserve slash down the interest rates? What happens is that the loans become cheaper. The loans, yes, the loans. Okay, whatever loans, credit cards, okay, home loan, okay, car loan, whatever loans. Okay, we talk about all of the loans. Okay, these loans become cheaper. When the loans become cheaper, then people can buy whatever they want to buy. Okay, because they are going to get the loan. Okay, and that too on very low interest rates, and this is what the Federal Reserve did earlier. Okay, so stimulus was there, money was coming in. Other than that, loans, okay, this was also because the Federal Reserve has cut down the, okay, slashed down the interest rates, so loans were available on the cheaper interest rates. Okay, so these two were the major factors, okay, that has given this the bullish, not bullish, heavy bullish movement to the stock market in a very short period of time. Now, if you notice that from the bottom of March 2020 to this the top, okay, so this was 120%. S&P 500 has gained 120% within within 2 years. Okay, in less than 2 years. Okay, gaining 120%, or sorry, not just 120%, gaining more than 50% in 2 years. Okay, that is not possible, and that was not supposed to happen. But in this case, the stock market has gained, in this particular case, the S&P 500 has gained more than 120% or more than 100%. This was exceptional. This was something that was impossible. This was not supposed to happen. Okay, that is the reason that we are seeing this, the downward movement is in the stock market. Now, I've told you the reason: stimulus package, rate cuts. These were the two primary reasons. Okay, then came this the third. Okay, there's the third reason. So this is the third reason. It is derived from these two, from these first two reasons. Okay, because people, okay, they have this the money from the feds. Okay, from the government. Government was supporting the people. Okay, rate cuts. So people, now people have, okay, they have had more money to buy whatever they want to buy. Okay, so if you want to buy an iPhone, yes, you can buy an iPhone. If you want to buy a Tesla car, you can buy a Tesla car. Okay, or people, okay, they were shopping online, heavily shopping. Okay, they were shopping online. Other than that, okay, people, because they were at home, okay, during this the pandemic, they have subscribed to Netflix. Okay, and other these the OTT platform. Okay, and then, okay, online shopping, etc. So this all has resulted in the revenue, in the increase in the revenue of Apple, Tesla, Microsoft, Amazon, Netflix, right? And because these companies have seen an exponential growth in a very, very short period of time. We have seen the stocks of these companies have skyrocketed very, very high, right? And then what has happened now? Okay, so this was the first part. This was the first part, okay, that why we have seen a very heavy exceptional movement in the stock market, stimulus rate cuts, and these are companies, okay, they have shown a very strong growth, and that is why the stock prices of the companies have increased, right? Now comes the twist. Okay, twist means what has happened is that everything was good, everything was perfect. Okay, but in the background there was something happening. Okay, and only a few were aware of this particular situation, right? And what was that? What exactly was, okay, that particular thing? Now, if you remember, so again, if you have subscribed to my YouTube channel and for more than a year, then in the month of January 2022, in the month of January 2022, I specifically mentioned, very, very clearly mentioned, and you can watch that the previous video, the technical analysis of January 2022, first week. Okay, I will specifically mention that, guys, year 2022 will mark the beginning. Year 2022 will mark the beginning of the bear movement, the recession. Okay, although this will not be an official recession, okay, but this will be a recession that everyone is going to notice, everyone is going to feel the heat. Okay, the stock market has moved, okay, to these the levels, to these exceptional levels, okay, and it is now trading at these the saturated levels. That is why the stock market is going to come down, entire stock market. So in the year 2022, S&P 500 will be able to hit 3700 to 3500 levels easily. Okay, now below 3500, okay, it will be needing some extra push. Okay, and but before it can actually go below 3500, it has to retrace a bit, and then it will come down, okay, below this the 3500, right? And if you notice, the lowest of 2022 that the S&P 500 has made, it was 3491, means 3500. This is what I told you 1 year before this thing, okay, has happened in the stock market. Okay, that was the first week of January, right? So this has happened. So this is what I'm saying, that only a few, okay, a few people and few analysts, okay, they knew what is happening. Okay, not everyone was able. See, everyone was seeing, okay, this is a bullish rally. People were buying, buying, buying. Okay, but at some point of time, it becomes saturated, oversaturated. But why it has become oversaturated? That was the main thing. Okay, oversaturated. So what has happened is that this this thing, this particular thing, this has fueled the inflation. Okay, so no one okay was talking about this the inflation earlier. Okay, not even the Feds. Okay, because they did not realize that the inflation is, okay, it is moving up. Now, why the inflation has moved up? That is the real question. The inflation has moved up because people have the money. Okay, money was there, money was provided by the Federal Reserve and by the government. Okay, so government was providing the money to the people. Okay, now, because people were getting the money, they were putting the money in the stock market, they were buying the things. Okay, whatever they wanted to buy, they were buying the things. Secondly, because of the pandemic, okay, not everything was available, and whatever was available, it was costly. Okay, some things, okay, were easily available, but even though the companies, they have increased the prices, so everyone has increased the prices because they knew that that the money that the people are getting, this money is not their own, rather this money is provided by the Federal Reserve, by the government. Okay, that is why people are going to pay whatever price they are going to ask, and this has what has happened. Okay, so some were, okay, so some, they have increased the prices, okay, prices of everything willingly. Some was first, and some were forced, compelled to increase the prices because of the shortage of the raw material and all. Okay, so overall, there was the increase in the prices. Okay, now, this increase in the prices has fueled the inflation. Inflation, okay, as per the Feds, inflation must remain around or below, not around, but below 2%. Okay, but this increase in the prices, it has fueled the inflation, and we have seen inflation hitting 9.1 or 9.2. Okay, more than 4 times, 4.5 times, okay, of the acceptable inflation rate. Right. So everyone, okay, people were celebrating, everyone buying, buying, buying. Okay, but again, this was something that only few were okay aware of this particular situation. Okay, and why it is going to create okay this kind of mayhem in the stock market. Right. So that was the inflation. Now, what has happened is that everything has means not everything, but yes, but we are now a little close to the pre-pandemic levels. But as of now, the inflation is still high. The prices of everything, okay, it is still high, and that is a point of concern. That now, if everything has come okay around to these the pre-pandemic level, then why the prices are so high? Okay, in just 2 years, like 50%, 100%, okay, or like 200%. So prices are extremely high. Okay, these prices were not supposed to be okay this much high. But the inflation, okay, inflation is not the reason why the stock market has come down. Okay, there are these the two reasons. Again, the same two reasons. Okay, what are those two reasons? Number one, the first reason is the stimulus. No more stimulus. No more stimulus package. Means no more money will be given by the government to the people. Okay, this is the stimulus package. These are checks. Okay, now because there is this so this the inflow of the money has stopped, means there is no fuel in the stock market. Okay, or whatever fuel, okay, it used to be pre-pandemic level, okay, only that fuel is there. Okay, so the fuel is gone, or this is the extra fuel, you can say. Okay, whatever, okay, it is gone, because people now they are not going to get this the free money, kind of free money thing. Okay, many people used to call it as free money. So now the people, they are not going to get this the free money kind of thing, right? This is gone. Number two, the second thing is that now there comes the increase in the interest rates. Now this increase in the interest rates, okay, now the Feds have realized that the inflation, okay, it has moved up. That is why they need to increase the interest rates in order to slow down the inflation, in order to cool down the inflation. By increasing the interest rates, Feds simply are going to bring down, okay, this the demand, okay, or the gap between the demand and the supply. Okay, and also between the jobs available and the job seeker. So there are multiple reasons, and I always talk about these reasons in every video. Okay, in all of my weekly technical analysis, I've given you this the reason many times. Okay, job seekers, okay, jobs available, there's a huge gap, and Feds are simply trying to okay fill the gap. Other than that, they are simply other than that, okay, by increasing the interest rates, okay, they are trying to fill the gap between the demand and the supply. Means Feds are simply trying to slow down the economy, okay, by increasing in the interest rates. And how it helps to slow down the economy, this the increase in the interest rates. Increase in the interest rates makes the loans costlier. Okay, now when the loans becomes costlier, or very very costly, in that case, now people, they, at this point of time, now the people are reluctant to buy a new house. Okay, because they are not buying these means not many people are buying the okay these the houses. This means that the housing market, okay, it will come down. Now the costly cars, okay, not just the costly car, but the cars, new cars. Now people, not everyone is going to buy okay this the car, because the loans are costlier. Okay, again the car market will come down. Okay, then the costly item means everything. So this is how, by increasing the interest rates, Feds are making the loans costlier. And because now loans are becoming costlier, businesses are not opting for the loans. They do not know whether they will be able to repay or not. Individuals, okay, they are also reluctant to the loans. That is why, okay, everything is slowing down. Okay, so this is what they are doing. So this is just the opposite of what was. This was where the stimulus was there, and and interest rate cuts. Okay, rate cuts. Okay, that was there. This is where no stimulus and further rate hikes, right? So this has caused this upward movement, this has caused this the downward movement, right? Now this is not the end of the story. Okay, so end of the story, okay, let me tell you. Okay, end of the story. So when I say this the end of the story, so what has happened is that the Fed chairman recently has confirmed in the year 2023 there will be no rate cuts. No rate cuts means the interest rates will remain higher, means the loans will remain higher. Okay, means if you place your money in the bank, then you will earn more interest on your savings. because the interest rates will remain higher. Okay, but if you are going, but if you want to opt for a loan, your loans will be costlier, right? So there will be no rate cuts in the year 2023, means no relief from the central bank. Other than that, okay, to make it more worse, Federal Reserve Chairman has confirmed that there will be further rate hikes. Means the loans will further become costlier. Loans are going to become more and more costlier. Okay, so the only at this time the only safe way to make money is to put your money, okay, in some savings account, okay, or somewhere where you are going to earn a heavy interest, because Federal Reserve has increased the interest rates to an means to very high levels, okay, where you are going to earn more and more interest on your savings, right? So this is 100% safe. You place your money in the bank and you earn the interest, and that is perfect, rather than placing your money in the stock market and then risking your money. Okay, so this the returns from the bank, it will be less, but it will be 100% safe. Okay, but now, and that is all because of the interest rates. Okay, so the loans, okay, loans will be very costlier if you have this a credit card over, so whatever is there, okay, it will be costlier. That is why it is further going to bring down the stock market. Okay, because there is no relief, means there is no fuel in the stock market. People, they do not have enough money to put the stock, okay, to put, okay, they are in the stock market, they do not have enough money. Okay, they are not getting any free money or any external money. Secondly, whatever money they have, okay, they are not going to put that money in the stock market, because now the people, they are aware of, okay, this thing, that everything is slowing down and a recession is coming, so now they are preparing for the recession. Means overall there is no fuel to move the stock market up, right? That is the problem. Okay, that is what is going to create this recession, right? Anyways, so we have talked about this thing, that thing a lot, okay, again and again. So I've mentioned this, and but now I believe that you okay, that this particular picture, okay, it is very much clear to you that why it is happening. Okay, now now comes the technical recession. See, technical recession will happen when these the moving averages will cross over. In simple words, very simple words. Okay, if you are my YouTube community member, okay, in that case, whenever it happens, like 1 or 2 months, then I will tell you. Okay, or if you are my subscriber also, okay, then in my weekly technical analysis, I will tell you. Okay, that if it has happened, because if you notice, last time when these moving averages have crossed over, this was the time back in 2008. 2008, moving averages crossed over. Okay, confirmed technical recession, down, heavily down. And how much down? From the moment the moving averages crossed over, from that moment to this, the downward movement, it was 50% down. 50% down, 50% down. Okay, so if we consider, okay, this math, the same, okay, number 50%, then let's see. See, again, the moving averages will, okay, moving averages have crossed over in 2008. Again, they have crossed over in 2010. So this was a period of 2 years. Okay, this was the Great Recession of 2008, right? But this time, this will be a little longer. Okay, that is why it will be again a Great Recession or the Great Recession, right? 50%, right? We have noticed that there was this the 50%, okay, downward movement. Let's say if the moving averages crosses, okay, somewhere around here, from this point, okay, to the 50% part. So when we go to the 50%, so oh, okay, 50% will be below 2000, 1900 something, so that will be okay, a little more. Okay, let's keep it to like 40-45%, okay, or to this, the previous level of, okay, this the March 2000, okay, 20, that the lowest was 2191 or 2200. Okay, so as of now, we can anticipate that during this the recession, okay, S&P 500 will be easily able to achieve, number one, it will be easily able to achieve, okay, around these levels, that will be 3000. Number one, it will be easily able to achieve 3000. Number two, it will be easily able to achieve the 200 months moving average. 200 months moving average is around 2500. Number three, it should be able to achieve 2200, because that was the low of the previous this March 2020. Okay, So we have 3000, we have 2500, 2200. In one exceptional case, if the recession becomes more severe, in that case it can move towards 1875, okay, to this level. However, chances are low, but still it can. See, this is the stock market, okay, and you never know, because we have never anticipated that the stock market will move to 4800 in very short period of time, okay. So again, although 1875, it is not in the picture, okay, as such, okay, but uh, again, okay, it's the stock market. Once this the selling begins, one thing, okay, once these the things become like more, okay, this okay, bad, okay, from bad to worse, in that case 1875, okay, it will be there in the picture. But again, guys, okay, what you must remember that we are talking about the recession, right? Recession is the best time, best opportunity. It is the best time to make a lot of money, a lot of money. You can make a lot of money. Why you can make this a lot of money? If you notice, these are green candles, okay, these green candles are the small candles, very small candles, right? This is what the bullish candle. If you notice the red candles, big candles, big, very big candles, okay, these red candles, okay, this is what I'm talking about. That recession is the best opportunity to make a lot of money, a lot of money, okay. So for example, okay, so whatever money you can make in like 5 years, okay, 5 to 10 years of bullish run, whatever money you can make in 5 to 10 years of the bullish run, the same money you can make in less than 1 year during the bearish run. Because bearish candle, red candles are always heavy, okay, that is why, okay, so 1 is to 5 or 1 is to 10. So the same amount of money that you are going to make in 5 to 10 years during the bull run, okay, you can make the same money, okay, in less than 1 year during this the recession or in the bearish run. So just stay tuned, okay, and subscribe to the channel, okay, so that you can get this the weekly updates. And other than that, okay, be a part of my YouTube community member, okay. And then once there becomes, okay, these the heavy red candles, okay, then we will see that that there is a lot of money flowing, right? And I'll give you these the daily updates and the daily analysis, okay. Now, guys, there is one more thing that I forgot to mention is that the recession, okay, why we are saying 2023 to 2025. The reason is that this, okay, okay, whenever, okay, this the stock market, the S&P 500, it comes down, okay. First, it will come down to the Chimoku cloud. Then it is going to take some support in the Chimoku cloud. It will give, okay, some kind of reversal. Okay. Now this activity itself will take a few months. Okay, and then it will come down, and then, okay, so this means, when I say, okay, there will be this the bearish movement, this does not mean that every month you will see back to back red candles. No. Okay, in between you will see some green candles and then some reversal. Okay, then downward movement, then some reversal. So what is the natural flow of the stock market? If you notice the natural flow of the stock market, okay, it is simple. The natural flow of the stock market says it moves up, down, okay, up, down, hold, then up, down, okay, then hold, then up, down, okay. This is how the stock market works, okay. So it is going to take some time. That is why I'm saying 2023 to 2025 in the technical terms. Now, in the terms of the Feds, okay, Feds have mentioned that the best, okay, or at earliest they can go for the rate cuts. Fine, not for the rate cuts, but to stop raising the interest rates in 2024. Okay, in 2024. So by the time the Feds will stop raising the interest rates, okay, in 2024, or even in this the quarter 3 or quarter 4 of 2023, okay, the economy will be extremely slow, okay. And to recover from this the slowness, economy will take 1 to 1.5 years, okay. So yeah, let's say, okay, if this happens by 2024, okay, mid of 2024, then it will take, okay, 2025 or 2026 to recover, right? So guys, this was all about recession. And okay, and guys, once again, the recession is not, okay, the recession is not confirmed until and unless there comes a crossover in the moving averages. Once there comes a crossover in the moving averages, then only the recession will be confirmed. That is why some analysts are saying that the recession might not happen at all, okay. But that is not entirely true, okay. As of now, 99% certain it is going to happen, Okay, all we are waiting for is a confirmation in terms of this okay, in this the crossover of the moving average. Once that happens, the crossover in the moving average, then we are good, means that then the recession is confirmed. So as of now, we need to wait until there comes this the crossover in the moving averages. Okay, so I'm not saying that that the recession will begin from the January itself, okay, from this month January itself. No, it might or might not be. Okay, all we need to wait for is the crossover. Once there comes a crossover, that will be the beginning of the recession. That will be the technical beginning of the recession, right? So guys, once again, if you have not subscribed to my channel, then please subscribe the channel and click on the bell notification icon. And if you want to get these the daily updates, the daily analysis of the S&P 500, okay, then you can join my YouTube community. And in order to join my YouTube community, you can click on this the join button, and you'll be able to join my YouTube community. So guys, now let's move on to the third point of our agenda, that is the S&P 500 support and resistance level. So I will tell you the support and resistance level for the S&P 500 and the probable zone, okay, that we can expect in the next week. And again, the next week will be the first week of the January. Okay, market will be more in the bullish mood. Okay, let's see how it is going to behave. Now, as we are going to talk about the support and resistance level, that is the third point of our agenda of S&P 500 technical analysis. And guys, once again, if you have not subscribed to the channel, then please subscribe to the channel and click on the bell notification icon. And if you want to join my YouTube community in order to get the daily analysis, the daily updates of the S&P 500, then you can click on this the join button that is there just below the title of this video, right? So guys, the support and resistance levels, okay. See, as of now, what we know is that no matter what, S&P 500, okay, it is not going to breach the zone of 4035. Even in the best possible case, okay, as of now, okay, at least for 1 to 2 weeks, okay, this is not going to happen, right? But okay, again, this is something exceptional, anyways. So what we can see is that the immediate resistance for the S&P 500 is the 3840 itself. The zone of 3840 itself is the immediate resistance for the S&P 500. And if you notice that it was struggling, it has struggled a lot in the zone of 3840, right? So this will be the immediate resistance. Then we have the next resistance at 3840, sorry, 3884. 3884 will be the next resistance, okay. Then we have 3907. Okay, this 3884, sorry, no, 3907. Okay, it can become, okay, or it may become the first tipping point for the S&P 500. Okay, means it can form a lower high here and then it will be down, right? Then comes the next point. So the next resistance, it comes at 3937. Okay, now this is a zone. Okay, so as of now, we are anticipating that whenever the S&P 500 moves up, okay, the zone of 3937 will be able to hold the S&P 500, the movement of the S&P 500, and beyond the 3937, it is not expected to move. Okay, as of now, okay, this is what we are expecting. Okay, other than that, in an exceptional case, okay, if it does, okay, in that case, we have 3965 to 3971. Okay, what is that? That is the 61.8% Fibonacci retracement level. Okay, to at max, okay, if it breaches the 3937, then it can move to 39, okay, this particular level 3971. Okay, and then, okay, there will be this the fall. Now, beyond that, okay, we have this the 3990, okay, and then we have 4035. So as of now, beyond 3971, okay, see, first of all, as of now, anything that is beyond 3937, okay, that is not there in the picture. Okay, anything beyond 3937, that is not there in the picture. And if that happens for some reason, okay, in that case, we have 61.8% of the Fibonacci retracement level, and that's it. Okay, so these are the resistance levels. Then we have the support. Now for the support, we have 3805, okay, immediate support. Then we have 3790, okay, next good support. Then we have this the 3760, okay, this is a fantastic support, very good support for the stock market. Okay, thereafter we have the 3735. This is the zone, okay. Okay, again a good support, but the one of the very important support, okay, it comes here at 3710. This is a very important support for the stock market, 3710, right? Thereafter we have 3675. So if something happens like drastically, if it comes down, then 3675 it will be able to hold, right? So guys, these are the support and resistance levels for the S&P 500. Now the zone, the probable movement of the S&P 500, okay, this time again the 3735, it comes into the picture. but this time, okay, the zone is now a little, okay, expanded in between the 3765, from 3765 to 3937. Okay, because of this, the movement in the stock market in last 2 days of the 2022. Okay, because of that movement, now the movement, okay, now we need to, okay, we need to just increase this the zone. Okay, that will be from 3760 to 3935. Now guys, let's move on to the fourth point of our agenda, and the fourth point is, now the fourth point is the S&P 500 technical analysis on the daily chart. So let's see, okay, what the technicals are saying about the S&P 500 and the entire stock market on this the daily chart, right? So guys, before I do the technical analysis of the S&P 500, I have this important information to share with you, that if you want to get these the daily updates, the daily analysis of the S&P 500, okay, from Monday through Friday, each and everything from Monday through Friday, then you can join my YouTube community. In order to join my YouTube community, you can click on this the join button that is there just below the title of this video. Okay, so once you click on this the join button, then this pop-up will open. So when this pop-up opens, then you will see that there is this the title, all midweek updates. All midweek updates means you will get the daily analysis of the S&P 500 from Monday through Friday, each and everything from Monday through Friday. And if you notice that my members, they have joined for last many months, and they are getting this the daily analysis, the daily updates of the S&P 500 from Monday through Friday, each and everything from Monday through Friday. So guys, whenever you want to join my YouTube community, you can simply click on this the join button and you can join my community. And guys, there is one more thing, that once you have joined my YouTube community, then you need to visit my YouTube channel page, and on this the YouTube channel page, you will see this the community section. This is the community. Okay, so you, whatever updates, okay, I post in this the community section, and you will find, okay, all of these the updates here in this the community section itself, right? So once again guys, whenever you want to join my YouTube community, so just click on this the join button that is provided just below the title of the video, right? Now guys, let's talk about the fourth point of our agenda. Okay, and the fourth point is the S&P 500 technical analysis on the daily chart. Okay, now let's do this the technical analysis on the daily chart. So in this the technical analysis, what we are going to see is that number one, okay, so the first thing is the Bollinger Band. This is the lower band of the Bollinger Band. This is the median of the Bollinger Band. Because the closing of the S&P 500 was below, was in between the lower band and the median of the Bollinger Band, this means that the S&P 500 is bearish through the Bollinger Bands, right? Then comes the Ichimoku. Because the S&P 500 has closed inside the Ichimoku cloud itself, this means that the S&P 500 is neutral through the Ichimoku, right? Then comes this, the moving averages. There is a clear fan out in the moving averages after the crossover. This crossover has happened after 2 months. Okay, the bearish crossover. Clear fan out in the moving averages. Okay, secondly, the S&P 500 has closed below all of the moving averages. This means that through the moving averages, S&P 500 is clearly bearish, right? Now let's talk about some other technical indicators. Some of the technical indicators, we have the MACD. Okay, so if you see MACD is less than the signal, this means that the S&P 500 is clearly bearish through the MACD. Other than that, both MACD and the signal, both are still bearish. Okay, so MACD is less than the signal, and both are, and MACD and signal both are negative. This means that the MACD is absolute bearish. Then comes the stochastic RSI. K channel is a little more than the D channel. This means that the K and D are bullish. This means that the stochastic RSI is bullish. However, both K and D are less than 50, means the bullish sentiments are there, but not much. Okay, volatility is normal, divergence is normal, all other technicals are normal. Okay, now what it means? It simply means that, see, S&P 500 is bearish through the Bollinger Bands. S&P 500 is bearish through this the moving averages. S&P 500 is bearish through the MACD. S&P 500 is neutral through the Ichimoku cloud. S&P 500 is bullish through the stochastic RSI. Okay, these bullish sentiments are there, but not much. What it indicates is that S&P 500 is now, okay, 70 to 75% bearish and 25 to 30% bullish. Okay, this is what these are technical indicators are indicating here on this the daily chart of S&P 500. So guys, once again, if you have not subscribed to the channel, then please subscribe the channel and click on the bell notification icon. And other than that, if you want to join my YouTube community, then you can click on the join button that is there just below the title of the video, and you will be able to join my YouTube community, and you will be getting the daily analysis of the S&P 500. So guys, now let's talk about the fifth point of our agenda, fifth and the last point of our agenda of this S&P 500 technical analysis, and this fifth point is the probable movement of the S&P 500 from January 3rd, that is Tuesday, to January 6th, that is Friday. Now guys, let's talk about the fifth point of our agenda of this S&P 500 technical analysis. And this the fifth point is okay, this is the last point, okay, of this the technical analysis, and this is the probable movement of the S&P 500 in the coming week from January 3rd, that is Tuesday, to January 6th, that is Friday. So the very first thing that you need to understand is that Monday is the holiday. Okay, so this means that there will be a short week from Tuesday to Friday. This will be a short week. So this is the first thing, that it is a short week. Other than that, you need to understand that this will be the first week of 2023, the very first week of 2023, right? Means by default there will be some bullish sentiments in the stock market. Now these two things are clear. Okay, now let's see, okay, how the S&P 500 is expected to behave, okay, in the coming week. So in the coming week, okay, yes, once again, if you have not subscribed to the channel, then please subscribe the channel and click on the bell notification icon. And if you want to join my YouTube community in order to get the daily updates, the daily analysis of the S&P 500, then you can click on this join button that is there just below the title of the video. Now guys, if you notice, this is the last candle that has formed. It's a bullish hammer. What is it? It's a bullish hammer. A bullish hammer that has formed after a green candle. What it indicates? It indicates that there were bullish sentiments by the time of closing of the stock market on last Friday. Okay, I mean Thursday and Friday, there were these the bullish sentiment. This is simply indicating. Okay, and now because the next week it will be a short week and it will be the first week of January 2023, by default there will be these the bullish sentiments, and now technically these bullish sentiments are supported, okay, because of this the bullish hammer. Now these bullish sentiments are supported by the technicals. Technicals means by the candles themselves. Okay, not these are technical indicators, but by the candles. What it indicates, that if everything goes by the technicals, if everything goes as is, then on Tuesday, on January 3rd, Tuesday, we will see, or we are going to see a gap. We are going to see a gap up open, or if not the gap up open, then irrespective of open, the stock market, the indices S&P 500 and the Dow Jones and the Nasdaq, okay, these are indices, and the entire stock market will try to move up irrespective of open. Okay, this is what it indicates. Okay, so if there comes no bad news, okay, and no such thing, in that case, most likely on Tuesday, on January 3rd, there will be this the gap up open, or irrespective of open, there will be this the upward movement. Okay, this is okay, this is the first thing. Now the second thing is that the S&P 500, okay, although it tried to come down, okay, on one day, even like on this the Wednesday, okay, even it closed below this the border, okay, but the next day it has simply given, okay, this upward movement. So what we can see that S&P 500 is trying to hold around, okay, this the 3840, sorry, not 3840, S&P 500 is trying to hold above 3805, okay, or this is the 3790. That is what we call as the border. That is what we call as the border. And again guys, remember the concept of the two consecutive closings. Okay, this is the border. Now the other thing, okay, that we have noticed is that whenever it tries to move up, okay, it has found the very strong resistance because of this the 3840. This is the zone of 3840. Okay, again and again, and this is what we knew very well in advance. When it was coming down, we knew that it is not going to breach, okay, this the zone. It will be there for 1, 2, 3 or 4 days. It will respect, re-respect, test, etc. Okay, so this is what we have noticed, right? So this means that if on Tuesday, means if there comes a good okay, there's a good gap up open, like 0.5% gap up open, okay, or like 1% gap up open, in that case, okay, this will be the first time, this will be, okay, this is the first time, okay, after many days, that the S&P 500 will be easily able to first of all open above the zone of 3840. That will be the best part. It will be open above the zone of 3840, and then it will be able to move up towards what? Move up towards what? Towards 3884. Okay, beyond 3884, then we have 3906. Okay, now this 3906 is the first tipping point. Okay, this is where we can expect the S&P 500 to form the first lower high. Okay, however, because it will be coming to the 3907, this means that now there are chances that it will be coming towards the zone of 3937, and this the zone of 3937. Okay, this is what I'm talking about for last 2-3 weeks, that a reversal or any reversal that comes, okay, most likely it will come to 3907 and then to the zone of 3937. Okay, and then this is, okay, so see, this is the this is our calculated, okay, this is the resistance level. Other than that, this is also the 50% of the Fibonacci retracement level. Okay, other than that, okay, this is a strong zone created by the confluence. This is the strong resistance level created by this, the confluence. Okay, this is the confluence zone. So this is a very strong resistance zone, right? So to this zone it can come, so either from this point or from this the zone. Okay, this is going to act as the tipping point. Okay, most likely this is where the S&P 500 is going to form a lower high. Okay, now in an exceptional case, okay, that is not going to happen on Tuesday or Wednesday. Okay, that will take some time, 2, 3 or 4 days. When it further moves up, then I guess either in this week, in the coming week, if not, okay, because see, it is going to remain inside the Chimoku cloud, or if it gives, okay, the two consecutive closings above the Chimoku cloud, then it can create a problem. Okay, because in that case it will be seen as the bullish movement. Okay, however, if it gives the two consecutive closings above the Chimoku cloud but below 3937, then that will not be a bullish movement. So the bullish or the bearish movement, these are conditional movements. Okay, so it is not okay, a straightforward thing that closing below 3805, okay, it will be bearish. No, it means that the two consecutive closings below the 3805, okay, it will be the mark, okay, or it will be the beginning of this the bearish closing. Okay, this is what I have mentioned this the previous week. Other than that, okay, two consecutive closings, then we also need to look into the this type of candle that is going to form. Okay, so there comes this the two consecutive closings, fine, but if there comes a candle that is supporting, okay, an immediate bullish movement, then the next day there will be this bullish movement. Okay, so it is not that easy to pinpoint, okay, to predict with this the pinpoint accuracy. Okay, on this the weekly. So we have weekly, okay, we have Monday to Friday, and a lot can happen, okay, in between this the Monday and Friday. That is why I have the YouTube community, okay, where I give the course corrections, that today it will be bearish, today it will be bullish, this will be this much bearish, okay, this will be sideways, etc. Right? So now, yeah, so I was talking about this. So now any movement, okay, first of all, as of now, we can anticipate that it will come to 50% of the Fibonacci, okay, to this the confluence zone, okay, or at most it can come here, and this will be the first point of, this will be the first tipping point, okay, or most likely tipping point. Okay, from this is where it is expected to form a lower high. However, if in an exceptional case, if it breaches, in that case we have, this is the 61.8%, 61.8% of the Fibonacci. Okay, chances are less. Chances are, see, anything that goes beyond 3937, beyond the zone of 3937, chances are less. Okay, okay, but if it goes, then we have 61.8% Fibonacci. Okay, that is the technical last, this is the last technical point where we can anticipate a reversal beyond 3971. Okay, there is nothing that can help the S&P 500, okay, to fall, okay, that heavily. Rather, there will be the technical that will supporting out, okay, a further bullish movement, right? So 3937, the zone of 3937, the very first thing, okay, very strong. Then in an exceptional case to 61.8% Fibonacci, that is 3971, approximately 3971. Okay, this is there, this is what we are anticipating, because, okay, because of this the gap up open or upward movement from Tuesday onward. This is what we are anticipating. Now when it comes down, okay, in that case now we have this the 3760. look at this, the 3760. Okay, 3760, it will be able to handle, it will be able to provide very good support to the stock market, to the S&P 500. So any downward movement will be handled by the 3760. 3760 will be able to handle this, the downward movement of the S&P 500. Okay, breach of 3760, it can happen. Okay, but we are not concerned about the breach, we are concerned about the closing. Okay, whether this side, okay, the breach of the cloud, whether this side of the breach of the cloud. Now we are concerned about the closing is what we are looking for, not just one closing but two consecutive closings, in order to confirm that whatever we are seeing, okay, it is not a trap. One closing can give you a trap, or okay, most likely, okay, it can create illusion. So that is why we need the two consecutive closings. Okay, and then okay, we need to look into the candle itself, that what kind of candle is, okay, it is going to form, means what kind of candle has formed, whether that candle is supporting the further fall, okay, or the upward movement, etc. Okay, so there are these, a lot of these are technical factors, okay, that play around. Anyways, so downward movement will be handled by 3760. Okay, and this the upward movement 3937. So this will be the zone. Okay, this is what I mentioned in this, in the support and resistance levels part. Okay, and other than that, now if it comes down, okay, if there comes a fall, okay, some good fall after this, the tipping point, or if it comes down from 3884 itself. Okay, in that case, first of all, two consecutive closings below the Chimoku cloud, means two consecutive closings below what, below 3760. That is what we need, two consecutive closing. If that happens, then we have 3735. Okay, it will be able to, again, it will be able to, okay, handle this, the downward movement. Okay, but if it doesn't, then we have 3760. 3760 is very, very strong support. Okay, it will be able to hold the S&P 500 at least for a day. And okay, so it will be able to hold the S&P 500 for one day, at least a minimum one day. Okay, 1 to 2 days. Then we have 3675. Okay, then further 3675 has the potential to hold the S&P 500 at least for one or 2 days. Okay, so this is the downward movement. So guys, once again, that the first point is the gap up open, or irrespective of open, the S&P 500 can move up. Okay, because of the formation of, okay, these the candles and this the upward movement. Okay, however, now there is, okay, there is the additional condition that I forgot to mention. Okay, the condition says if there comes a gap down open or a flat open, for any reason, if there comes a gap down open or flat open, then also it will try to move up. Okay, as per the concept, it will try to move up, not a problem. But in that case, what will happen, the upward movement may not be that strong as we are anticipating. Okay, so because it will not be strong, this means that the at most, okay, it can move up to 3860 or to 3884. That's it. Okay, and it won't be able to move up, any higher. Okay, in that case, and if it want to move up any higher, then it has to give a kind of closing. Okay, there is a special kind of candle, okay, that can help it to move up. Okay, if that candle forms on Monday, okay, then only, sorry, Monday, no, Monday is holiday, Tuesday. If that kind of candle forms on Tuesday, then only, okay, it can move up, right? So yep, so that is, if there comes a gap up open, then it has the potential to move up to 3937. If there comes a flat open or a gap down open that is below 3840, okay, or in the zone of 3840, then the upward movement will be means a little restricted. Okay, so we need to then look into this intensity. Okay, and these are other factors, right? So guys, because, and once again guys, Monday is the holiday, and because this will be the first week of the January. Okay, so generally the first week of the January, okay, by default it brings the bullish sentiments, people are happy. Okay, everybody is okay. So guys, once again, whatever happens, okay, on this the day by day basis, okay, I will tell you through these the community notes, okay, each and everything, okay, what is happening on this the daily basis, right? So if you want to join my YouTube community, then you can simply click on this the join button that is there just below the title of this video. Okay, and you can join my community in order to get the daily analysis, the daily updates of the S&P 500, and then I will tell you what is happening, okay, on this the daily basis, right? And guys, other than that, if you're not subscribed to the channel, then please subscribe the channel and click on the bell notification icon. And guys, if you like this video, then please hit like. So guys, this was my S&P 500 technical analysis for the week of January 3rd, 2023. That is from January 3rd, Tuesday, to January 6th, Friday.